Coming up, the 10 worst financial mistakes you can make during retirement. We'll tell you what they are and how to avoid making these mistakes. And we'll hear from Jill Schlesinger from CBS MoneyWatch on the markets and the economy. That's next on Your Money Matters, presented by the Presley Group.
And welcome back to Your Money Matters, your weekly peek inside the complex financial world. You listen to the show so you can retire with peace of mind. And what better people to tell you about that than Christy Smith, president of the Presley Group, and Matt Kennedy. Christy and Matt are experts at helping you plan for a successful retirement. They teach their clients how to position their retirement money to avoid losses due to stock market conditions. They have helped hundreds of clients achieve their retirement goals, and they can help you. Here are your hosts for Your Money Matters, Matt Kennedy and Christy Smith.
Good morning and welcome to Your Money Matters, brought to you by the Presley Group. I'm Christy Smith, excited to be here with you this morning, and I'm joined with my co-host, Matt Kennedy. Good morning, Matt.
Morning. Got a lot to talk about today. 10 worst financial decisions you can make in retirement. You know, a lot of people are looking at retiring, or maybe you're already retired. We're going to cover the 10 worst financial decisions you can make in retirement. We're not going to just tell you what they are. We're going to tell you how to avoid making these bad decisions. It's been a rough week on Wall Street. We'll talk about that. Jill Schlesinger from CBS MoneyWatch will be here to give us her analysis of the economy and the market and where things stand. But we have to start by saying congrats to Presley. State champion, right?
Absolutely. She is now, she now owns the title, the Louisiana Junior High Rodeo Association state champion.
That's awesome.
I'll tell you what, Matt, that was a nerve-wracking weekend. Last weekend, Presley competed at the Burton Coliseum in Louisiana, Lake Charles, Louisiana, to earn the title. And she had to make 3 clean runs, and you and I both know in 14 seconds a lot can happen.
That's a lot of pressure.
And she just pulled through, and we are so proud of her. But we're really proud of all of the contestants, to be quite honest with you. It was a good, safe weekend, no major injuries, just a few little small things. And,
good.
We prayed a lot that God was going to take care of all the kids. They are all in junior high, and he provided for us, and we're just so grateful for that.
That's awesome. And now does she go to nationals or something? Is the next stop like a national competition?
Well, we're now headed to Gallup, New Mexico. She'll attend the National Junior High Rodeo Association rodeo and try to earn the title national champion. Woo-hoo. We're excited. And you know, one of the things that I love the most about Presley is that, well, she is very dedicated to her sport. But I love the fact that Presley is really a strong Christian. You know, she really sets an example for the other kids. And
awesome.
She amazes me on a regular basis, you know. Last week, she was honored with many different awards. And she received at school. She received the highest GPA in her class in math, science, English, social studies, and Spanish. So not only does she excel in her rodeoing, but she also excels in the school. And I'm just so proud of her.
I was going to say, I couldn't tell. You're not proud of her, are you?
Oh, so, you know, I get asked this question, Matt, all the time. People come into the office and they think that Presley's my only child because we talk about her rodeoing all the time. But, you know, I do want to say that I do have 2 other children that are in college. I'm very proud of them as well. Coleman, actually, I received a letter on Coleman about a week ago stating that he made the president's list at Southeastern last semester, and so I was naturally very proud of him. And my daughter Alexis is still in Natchitoches, going to Northwestern, and you know, I'm very blessed. I could not be more blessed.
Yeah, Ryan, my son's at LSU. He's doing okay. I mean, he found out high school and college aren't the same.
Now, is he going to summer school?
No, he's not doing summer school. He's working. He's making some money. But Lauren, my daughter, made a 4.0 at Dutchtown in her last semester.
That is great.
I think her overall GPA was like 3.9, so
That's
she
awesome.
did great. So.
Now, before we dive into this, I just got to ask this question, you know, because I know you're slow to brag on your children, but didn't Lauren have a major accomplishment with
oh yeah,
is it FFA or
well, it's FFCLA. It's like It's what home ec was when we were in school, but
Right.
now it's more all-encompassing. Yeah, and they being Dutchtown, and my daughter was on the team, they were the state champions of FFCLA.
Wow,
And my
that's got to be a big honor
It
as
was
well.
awesome. My daughter can bake, too. She's got to bake you something.
So she had to do a lot of work to earn that honor.
A lot of cooking, baking, sewing, all that good stuff. So,
Wow.
yeah. We're blessed. We sure are. And we hope your families are doing well as well.
We're forgetting that this week we had a real blessing with our business. You know, I had the opportunity to participate in writing a chapter for a book with Brian Tracy. That book is called The Ultimate Success Guide. And Matt, a week ago, last Friday, it hit the bestseller list on 5 different lists.
Wow.
So we're real excited about that. We're offering a free copy of that book to anyone who comes into the office and schedule, or if you call and schedule a complimentary visit to come in and meet with us, we'll send you a copy of the book. Or if you want to attend our workshop, which I'm going to talk about in just a minute, we'll give you a copy of the book at the workshop. We're hosting a workshop on June 13th.
Right, this coming Thursday.
It's at 6 o'clock. It is here in Baton Rouge. And Matt, there could not be a better time for us to discuss retirement in the new economy when
Yeah.
you look at what the stock market has actually done over the last week. I mean, we have seen a lot of volatility in the market.
Yeah, we're about 5% down from May highs, so there's definitely a swoon on Wall Street. If you'd like to attend this workshop, we're going to talk about how to guarantee yourself retirement income, how to protect yourself from losses when the market takes a dive like this. We're going to talk about, well, retiring in the new economy, discussing our debt, our deficit, what it means for Medicare, Social Security, etc. It's free to register, but we only have a few spots left. Again, it's this coming Thursday at 6 p.m., June 13th here in Baton Rouge. To register, you simply call us at 791-5773, 791-5773, and feel free to bring a guest, bring a friend, bring a few friends.
Well, and
we'll all
don't
learn
forget,
together.
everybody that comes into the workshop is going to get a free copy of our book, The Ultimate Success Guide with Brian Tracy. And you just couldn't find a better time to start looking at your
Right.
options. You know, how many of you are on the verge of retirement? Have you looked at your 401k accounts in the last week? Certainly you've seen the change. Is this something we should expect, more of in the future? Well, we don't have that crystal ball, and we can't tell you for certain that we think the volatility is going to continue. But what we can tell you is that, there are factors that lead to this kind of volatility. And we do know that at some point, the federal government is going to quit printing money. We do know that can have a direct effect on inflation. It can have a direct inflect. I can't talk this morning. It's going to have it can have a direct correlation to jobs.
Absolutely.
It really affects so much. And so now is the time. You don't have to sit and wait and watch those 401k accounts drop 20-30% like we all saw happen in 2007, 2008. Now's the time to take action. And so we're having this workshop. It is a free educational workshop. We are not going to be selling any products. A lot of times people think that, those workshops are there for us to try to sell you something, but they're really designed to be educational, informative, and we will give you an opportunity at the workshop to schedule a free consultation to meet with either me or you. And so give us a call and schedule your reservation to attend the workshop. Our number is 791-5773, 791-5773, or you could go onto our website. We've got a newly designed website, safemoneyplan.net. Gotta remember, it is not .com. It is .net. You can go on our Facebook. Have you looked at our Facebook lately, Matt?
It's great, yeah.
It is a great. Taylor's done a great job on it. Like us on Facebook. That way you'll start getting updates. Anytime we see something that we think might help you, we're going to post it on our Facebook. So go on and like us on Facebook. call and make your reservation today, or go on the website and just tell us you want to make a reservation, and we'll call you and get it scheduled.
There's a website I use frequently, Christy. You and I look at it, and I grab articles from it. Investopedia, not encyclopedia, Investopedia. And there's lots of great information there. There was an article up there in late May, the 10 worst financial decisions you can make in retirement. I thought we'd talk about some of these, since we are retirement planners and we help you prepare a safe, worry-free retirement. Let's talk about the mistakes you don't want to make. Number one, assuming you will retire at a specific age. Now, this, Christy, is really a pre-mistake retirement.
Right.
But the article basically says you got to start talking to a professional and making a retirement plan well in advance of retiring. A lot of people wait till the last minute, 6 months, 3 months before they retire, or before they think they're going to retire. I guess I better call somebody. Then it becomes overwhelming. Don't make the mistake of saying, yep, I know it's 65, I'm going to retire. What's going to happen with your job? What will happen with your health? What will happen with the economy? What's going to happen with the market has to be a concern. So if you think you're going to retire at a certain age, be careful. That age could move.
Well, sometimes where that comes back to bite us, Matt, is that we have things happen that are not within our control. You know, retiring is a decision, okay? But a layoff is not a decision. And so we don't know. We see companies cutting back, especially right now. We're on the verge of all this Obamacare coming into play.
Yep.
We do know that there are companies laying off so that they can get under that 50 mark. They don't want to have to provide that benefit. They don't want to have to worry about it. So they're cutting back. You know, a layoff is something we can't control. So a lot of times we think we're going to retire at a certain age, but circumstances, you know, come into play that change that plan. And so what we want to do is we want to start planning early for retirement. That way, you know, if something comes up, then we just change directions. It's not going to be detrimental in our retirement plan, because, you know, planning or failing, not people that don't plan, that is really the biggest mistake.
Absolutely.
In my opinion.
Not
you know,
having any
not
plan.
having any plan. And so, you know, retiring at a certain age, or in your mind planning to retire at a specific age, is definitely one of the worst things that we can do. But, you know, in the same respect, sometimes it's you know, it's not our own decision when we're going to retire. Other factors come into play. And so I guess what I want to say is more important than anything with that is that having a plan, you know, having a plan so that, you know, 2, 3, 4 years before you are scheduled to retire, if something changes, you're not devastated.
Number 2, these are the 10 worst financial decisions you can make in retirement. Now, these aren't listed in any specific order. This is just the way we're giving them out. Number 2, relying on the advice of friends and family instead of a professional. I've got to tell you, Christy, we're professionals, so we want you to come see us or see a professional. But the mistake that I find, and I know the mistake that you've seen in 16 plus years of doing this, well, my friends, my family, they went to this broker and they had a good plan, so I guess that plan's right for me. No, your needs may be completely different. Seek out 2 or 3 pieces of advice. Find your alternatives, because everyone's situation is different.
Well, and not only that, what I find is that often people try to give good advice. You know, friends try to lead you in the right direction, but often they just simply don't know. You know, let's think about annuities as an example of that, Matt. You know, how many times have you heard someone come in and you start talking about an annuity,
and they wrinkle their nose up,
and they go, "Oh, but my next door neighbor told me I should never buy an annuity. That's really the worst thing that we can do is to buy an annuity." And the reality is that the reason the neighbor has cautioned them is because someone they know was, or even themselves, were probably unhappy with an annuity that they purchased. Okay, but what unfortunately happens is that people try to group it all together into one category, and annuities can be so different that you really get bad advice. So again, let's talk about this. If you had a brain tumor, okay, and you needed brain surgery, are you going to go to your general practitioner to get advice on that brain surgery?
No.
Or are you going to seek out advice from a brain surgeon?
I want to go to a specialist.
That's the same thing we need to do with our retirement monies. Because even financial professionals all specialize in different things. We've got brokers that are specializing in the accumulation mode. They're the ones that are good at saving while you're young, long-term saving and investing. But the reality is that when we retire, we have to look at that portfolio in a different way. And so you really need to see someone that specializes in retirement planning. And that's what we do. And we're going to talk about that at our workshop on June 13th, next Thursday. If you want to seek out help from a specialist, give us a call and reserve your seat to attend our workshop next Thursday here in Baton Rouge. I think it's at 6 o'clock, and start learning from a specialist. Don't settle for the general practitioner's advice when it comes to retiring. Settle for the brain searching,
Exactly. Somebody
so
who
we're
can
here to
help
help
you. Somebody who can help you with the decumulation of your money, taking the money out and using it in retirement. To register, simply call us at 791-5773. It's free to attend this Thursday at 6 p.m. Again, that's 791-5773. We'll come right back. When we come back, more of the worst financial decisions you can make in retirement. And we'll also hear at the end of the show from Jill Schlesinger from CBSMoneyWatch.com when we continue on Your Money Matters. And we're back. Your Money Matters here on Talk 107.3 FM, presented by the Presley Group. I'm Matt Kennedy, along with Christy Smith. We're talking today about the 10 worst financial decisions you can make in retirement. Number one, assuming you're going to retire at a specific age. Life happens, Christy. Sometimes you have to work longer than you planned.
Yes, and sometimes you have to leave work before you plan.
Number two mistake is relying on the advice of friends and family instead of a professional. Just because they're your friends and their family doesn't mean they know all the dynamics of your situation. Not only that, Christy, but many of you may not be comfortable talking to your family or your friends about your situation.
Well, we see that even in the medical field, because I'm learning this with my 21-year-old daughter. When something's going on with her, she don't want to give me all the facts. She gives me just what she thinks I need to know, and then as I dig into it, that's when I find out that there's more to it. And so a lot of times people don't want to talk about all of their situation. Maybe they give them bits and pieces or talk in generalities, but the reality is that in order to have a good financial plan, you need to know all the specifics and design a plan that's going to fit your needs, and everyone's needs are quite different.
Number three, boy, this is a big one, starting Social Security too early. Christy, how often do you and I sit down, talk to someone, and they say, oh no, we're taking Social Security at 62. Oh yeah.
Well, I hear that a lot.
And then we show them, well, if you take some of your nest egg and you begin to take it out as a distribution, say, over 5 years, and you delay your Social Security until you're age 67 or even 70, look how much more money that means in your case. Everybody's situation is different, and one of our great insurance companies we work with, Allianz, has a brand spanking new Social Security calculator that they've made available to Christy and I. And when you come in to meet with us, we can input all of your data, age of retirement, longevity expectations, COLA expectations, cost of living, and show you at what age it would theoretically be best for you to draw Social Security. It's a powerful tool that we've just gotten our hands on.
Unfortunately, what I hear a lot is that people want to jump on Social Security at 62 because, especially with everything going on right now, with the debt and the problems that we see with our economy, people are really getting more and more fearful that if they don't get on it at 62, they may not get it. But the reality is that that can have negative consequences on you in the future. And so Social Security is a big decision, Matt, and it can definitely be one of the worst decisions. Jumping on it too early, it can be a very bad decision. And it may need to learn your options.
It may also be a bad decision if you wait too late. It may be a bad decision if you misfile. What I mean by that is if spouses don't do it right, that can be a big mistake that can leave lots of money on the table.
Well, and just the other day I was working with an existing client, and he's approaching retirement. He's got about 3 more years before he retires. And one of the things that we do is we go over the expected Social Security payment with our clients when they come in for an annual review, especially when they're getting that close to retiring. And what we noticed, Matt, is we noticed that in 2011, Social Security did not have him down with any wages. And in fact, he was making over $100,000 a year. So, learning about your options with Social Security can actually help you, because you might see where there's a mistake that can impact you in the future. There is time limits on when can you catch that mistake and actually get it fixed.
Well, and they're not mailing out statements anymore. You have to go online. And this gentleman just overlooked the fact that in 2011, they basically said he made no money.
Absolutely.
Well, that has a huge impact on your Social Security benefit.
Yes.
Number 4, fourth worst financial decision you can make, overlooking tax consequences. We're not tax attorneys, so we're not going to spend a ton of time on this. But remember, when you have an IRA, when and how you pull out that money absolutely impacts you tax-wise.
Well, and that's why it's so important for those of you who are young and saving to consider other options to retirement savings besides 401k or traditional IRA savings. You might want to look at a Roth account. You might want to look at building a tax-free retirement plan. Starting early to plan for retirement is really beneficial, because you can really plan to eliminate or avoid as much in taxes as possible when you do retire.
Now, another mistake, not updating your retirement plan. Oh, we see this one so often. They write, reaching retirement doesn't mean it's time to abandon risk. Many retirees make the mistake of dumping high-risk equities from their portfolio in favor of low-risk but low-yield bonds. The problem, they write, is that bonds don't necessarily provide the long-term potential required to sustain a retirement income for 20-plus years. And Christy, Jill Schlesinger.
I'm reading this right now.
Jill Schlesinger is going to talk about this coming up in our next segment. But Jill Schlesinger from MoneyWatch says one of the concerns is interest rates have started rising. So be very careful if you're in bonds or bond funds, because when interest rates rise, yields fall. Be very careful.
Now, I'm also reading further in the paragraph where it states that annuities can provide a guaranteed revenue stream. We're starting to see more and more economists understand that annuities can be a powerful planning tool in retirement. I got to tell you, Matt, 16 years ago when I started offering fixed indexed annuities as a safe money strategy, we just didn't see any economists, saying, hey, you might want to consider using an annuity.
Well, it's because now, it's 16 years ago, everybody was making 20% a year in the stock market.
But now you're seeing it really as a common theme amongst many of the economists.
Not only the economists, I met with a couple on Friday, and they get it. I wanted to hug them. They said, Matt, it's real simple. Here's how much we have in our portfolio. In 7 years, here's how much money we know we're going to need to maintain our lifestyle. I said, no problem. Why don't we still contribute to your 401k? Keep doing that. But let's take that part of your nest egg today that we can guarantee as income in 7 years. Mm-hmm. That's called creating a plan.
Well, we're seeing it more and more, and I got to tell you, it makes my heart smile when I see it, because I can tell you, I remember the day where you never heard of an economist saying, hey, you might want to consider an annuity.
Another mistake, failing to understand distribution. Now, this gets a little technical. The article talks about how just be careful you don't withdraw from your IRA before age 59 and a half, or your 401k before age 59 and a half, because you may incur a 10% IRS penalty.
Well, and not only that, you want to make sure that you're cautious as to how much you withdraw out of your IRA accounts on an annual basis after you reach retirement age, because you could, by just pulling too much money out that maybe you didn't really need, you could incur more in taxes, and then that's just giving your money away to the federal government. Mm-hmm. So we don't want to do that either. Again, proper planning can eliminate that.
Let me tell you a plan I'm working on right now, and you have been helping me with this plan. We have some clients who have some substantial money still sitting in a 401k. They've retired, but a substantial portion of their money is still in a 401k. we're actually looking at having them begin drawing money out of their 401k, buying a life insurance policy because they're both in good health in their early 60s, and using the proceeds of that life insurance as a tax-free death benefit. Yes, they're drawing down their IRA, but what are they really doing, Christy? They're converting taxable money into tax-free inheritance for their kids. That's another strategy. We call it the life leverage plan, and we can help you with that. If you aren't necessarily having to live on the IRA, why not take care of the taxes now and not pass the tax burden along to your kids?
Well, and many of you think that because you're still working for a company and contributing to your 401k plan, you just assume that you're not able to really do anything with that plan. But if you're over 59 and a half, many of you will have the option to do what's called an in-service distribution.
That's
where
correct.
you can take a portion of that 401k plan while you're working and while you continue to contribute to that plan, and you're able to position it in a different environment. It avoids taxes by doing it because you're doing it as an in-service distribution, transferring directly to an IRA. But now you're able to put it into a plan that offers a little more stability. When we go back to updating your plan, I hear from people all the time that when they're working and saving into these 401k accounts, they just don't have someone that's there that they can talk to about managing that 401k account actively. And so, many of them feel like they've made bad decisions in the past because they simply didn't know what choice to choose. Well, it's kind of like this. As you get closer to retirement, if you don't have someone there, driving the car, getting it ready for you, then you can easily wreck.
Yep.
Okay. But taking control of your own 401k and putting it into a plan where you now have someone that you're working with, that you've built a relationship with, that's really driving the car for you and keeping you informed of everything and protecting you so that if we do see another downturn in 3 months from now, I mean, we're seeing a downturn this week. But,
we are.
But it's not going to be the downturn that I believe we really are facing in the future. The thing is that it's not going to wreck your plan. It's not going to change that retirement date because you've taken control of that. You've accepted responsibility. You've learned your options, and you've created now a safe plan. And so it is important that you start learning now. Again, don't forget, we've got that educational workshop coming up next week. It's on the 13th here in Baton Rouge, 6 o'clock. It is totally free. You just simply have to call us and reserve your seat. Our number is 791-5773, 791-5773.
Okay, there are 4 more of these we need to talk about. 4 worst financial decisions you can make in retirement. We have about 4 minutes left, so let's go right through these.
Got to cover them quick.
Underestimating future health care spending. We could spend an entire show on this. Maybe long-term care is what you need, a long-term care plan. We can talk to you about that as well.
Well, and with all the changes with Obamacare coming, I don't think any of us really understand how that's going to impact us in the future.
I will say this. We have income plans that from some of our insurance carriers that if you fall ill and you're receiving a regular steady income from the insurance company, we have companies that will offer for up to 5 years double the income payment to help offset long-term care expenses.
And that's a company called Security Benefit. They're really unique with that option. We don't see any of the other companies going in and doubling the income, but that's a company called Security Benefit, and the plan is called the Secure Income Annuity.
And it really, really can provide you with some great protection should you fall ill. Okay, this is the one we could spend 2 hours on. Failing to diversify your risk. 10 worst financial decisions you can make in retirement. Failing to diversify your risk. This one's very simple. Do you want to have all of your eggs in the stock market when you need to count on those eggs for your retirement income? You better not.
Well, and we could also say the same with, do you want to have all your eggs in a fixed indexed annuity? A lot of times proper planning requires balance.
Absolutely.
And so it is very important that you find that balance when we're dealing with retirement monies.
And I want you to understand, folks, when you work with Christy or Matt at the Presley Group, it's never an all or nothing proposition.
No.
Some people don't want to call or attend a workshop because you've had a bad experience in the past.
Yes.
And someone tried to shove a pen in your hand and say, here, I want all your money. Well, they didn't say that, but that's what they were saying. We truly are here to help you come up with a plan. We're here to help you sit down and say, what do I know I need in retirement? How much do I need safe? Our plans never put your money at risk in the market. Now, if you want to bear market risk, that's fine. But we'll help you diversify so that you know you've got a portion of your nest egg tucked away safely there for you in retirement. The ninth worst financial decision is staying way in debt. They write you should make paying off high-interest debt a top priority, especially approaching retirement. Do not get saddled deep in debt during retirement.
Well, and I'm seeing more and more often as we see these baby boomers retire, that they are carrying a much bigger debt load than even 15 years ago. When I would meet someone that was actually retired already, their goal was to be out of debt before they did retire. But we're seeing baby boomers now retire at 65 and buy new homes and finance 80% of the home. So this is really this is in my opinion can be one of the worst decisions is to retire with too much debt.
And number 10 ties right into that one, refusing to downsize your lifestyle. It's not easy, Christy, making the transition from working and having a steady paycheck to all of a sudden not having a job. Then you want to travel. This is why we often stress, what do you need as your foundation for income? If you've got a pension, great. If your Social Security can be there for you at 65 or 66, whatever, great. But what other monies do you need coming in regularly to make sure that foundation is built beneath you? It's about a foundation. At our workshop this Thursday at 6 p.m., we're going to talk about the rule of 100, how to create income, how to guarantee you don't take losses when the market goes down. We invite you to attend. Our number to register is 791-5773. Plus, we just want to meet you, 791-5773, or you can register online at safemoneyplan.net. Christy, I know you've got to run. When we come back, Jill Schlesinger, editor of MoneyWatch.com, contributor to MarketWatch.com, is going to give us some insight on where the economy, where the markets stand, and what's up with all the bond buying and the market correction. We'll hear from her when we continue in a moment here on Your Money Matters on Talk 107.3 FM. And we're back on Your Money Matters. Good to have you with us. Your Money Matters presented each week by the Presley Group. Our website is safemoneyplan.net. That's safemoneyplan.net. Okay, every week we like to talk to a guru, somebody who has their finger on the pulse of the economy and the stock market. Joining us now from CBS MoneyWatch, she also writes for MarketWatch.com, is Jill Schlesinger. Jill, it's been a wild week. The market's been up and down and up and down. What's going on?
Right now, the economy is slowly improving. It's not so horrible, right? We're going slow, but it's getting better.
Yeah.
We know that the stock market is up about 14 to 15% this year, and so yeah, okay, there's a little pullback now. No big deal. I don't want everyone to freak out about this. This is normal. What's more interesting is probably what's going on in the bond market, and you'll notice that if you're going to check rates for your mortgages and things like that, rates have crept up over the last couple of weeks, and the reason is that people are really trying to figure out, will the Federal Reserve slow down its purchase of bonds sooner rather than later? And if they think it's going to happen sooner, then they're going to sell some bonds off in advance of that, and bond prices will go down, rates will go up. Now, there's also sort of a double-edged sword with that. Okay, rates go up a little bit. That may be bad if you're borrowing money for a mortgage, but it's pretty good if you're a saver.
Yes.
So there's a lot of sort of good news in all of this, and we don't want to get so greedy that we forget that actually this has been a pretty decent year after a very good year last year, and a little fallback in stock prices, that's to be expected.
Jill Schlesinger with us. Jill, can you take us back one step? Explain how the Fed's bond buying program helps the markets and helps the economy. Kind of give us a primer on that.
Okay, that's a great question. So this has been called quantitative easing. And, you know, when the Fed first started this, right in the heat and the disaster of the financial crisis, it literally was going out and purchasing bonds and giving liquidity to the market because no one else was going out and buying bonds. And everyone was so fearful that things just were frozen. the next permutation of quantitative easing was supposed to really help spur economic growth. Now, how does that happen? Well, if the government or the Federal Reserve buys $85 billion of bonds each month, presumably that will help keep interest rates lower. When interest rates are low, it tends to spur some economic activity. Like
Correct.
I'm more willing to borrow for a mortgage. If I'm a small business, I might borrow some money so I can do something with that money. And that's one thing. But, you know, the real interesting part of this bond buying is that it has literally boosted stock prices and other assets because when you look at all the different investment choices out there, all of a sudden they start to look pretty crappy. And as a result, a lot of investors said, I can't buy bonds. Prices are still very high. I can't go out and buy gold. That's too risky. Real estate still seems scary. And so the largest beneficiary of this bond buying has been the stock market because investors are simply left with such rotten options for their investments that they figure stocks are the best thing. Stock prices go up. A couple things happen. One, confidence improves. Two, these companies are actually worth more money. They beef up their balance sheets. They can do different things with their money. They can make some deals. And, you know, overall, what tends to happen from the Fed's point of view is it starts to spur overall economic growth. We're not sure that's actually happened. I mean, really what we absolutely know has happened is that the Fed has helped keep the stock market higher, at least in the last 6 months.
And, great explanation, thank you. And, or maybe I should say, but, from what I've been reading, say, at CNBC and MarketWatch.com, et cetera, one of the concerns, though, among some economists, Jill, is that if Ben Bernanke lifts his foot off the pedal and the bond buying slows down, then the market's going to go way down. That is still a very real concern, though, right?
Absolutely. I mean, one of the rationales for buying stocks is because the alternatives look bad, right?
Yeah.
Well, if all of a sudden the bond market is dropping and prices are lower in the bond market and all of a sudden interest rates are going up a little bit, maybe you'd be more willing to buy a bond, right? And so, yes, if this were to be a messy unwind of Fed policy, we could see a dramatic change in asset prices, okay? That, like, we really could see something bad happen. The Federal Reserve has said, hey, guys, stop freaking out. We know you're worried about this. We're never going to do something dramatic. We're not going to go from $85 billion to zero in a month. We're going to taper it down. Maybe it'll be 85, and then 1 month it'll be 80, and then it'll be 75. But with the economic data that has been released over the last few weeks, it's hard to justify the Fed really changing their policy anytime soon. Just because they're kind of talking about it doesn't mean they're going to do it. I think they're talking about it, frankly, to do exactly what is happening, which is to get people to perk up and say, hey, you cannot count on these low interest rates forever. Don't pile all of your money into stocks thinking we're going to be doing this. So be much more prudent as you put your money to work.
Last but not least, what's up, Jill, in Japan? The Nikkei has been hammered. And, you know, Japan was involved in a lot of bond buying and things, too. Is this symptomatic of what's happening in America or completely separate?
Well, I think it's associated. Look, Japan has been in literally a 20-year stuck economy. 20 years, can you imagine? And so when the new prime minister was elected, he said, I'm going to do something different. I am going to really concentrate on economic growth. And he's been true to his word. Now, part of that is that the Japanese central bank actually went and announced a similar kind of bond buying purchase program in Japan. And I want to also say that Japanese stocks have been rising prior to that announcement.
Yes.
So they were up very dramatically over the last 6 months. So the new announcement is made, and then the stock market in Japan goes nutty. I mean, like crazy up. And it was up so dramatically that in the last couple of weeks, I think some investors have said, whoa, that's too far, too fast. We've seen a real correction, a more than 10% drop since the top. It's been, I think, 17, 18% from the top. And you know what? The Japanese stock market's still up this year. So you can't even believe that you could have a 17, 18% drop and you're still up over 20% on the year. That just shows you that things kind of went a little too crazy on the upside and investors taking some money off the table.
Jill Schlesinger from CBS MoneyWatch. Jill, thank you for the time. Good insight there. Of course, Friday we got the jobless number that came out. Unemployment ticked up to 7.6%. So definitely it's a very slow healing economy. And it's an economy that is recovering thanks to Fed stimulus. I'll tell you the one thing we keep hearing over and over is bond buyers beware. And if you're in bond funds, really beware, because as these interest rates begin to creep upward, those bond funds could be at great risk. Ultimately, the question boils down to, are you prepared for retirement? Would you like a plan that says, look, when the stock market rises, you earn money, but when the stock market tanks, you're not at risk? Would you like a plan that says, I need guaranteed retirement income, and my plan offers me a guaranteed monthly paycheck as long as I live and as long as my wife lives? Would you like a plan that gives you the potential to link your gains to the stock market without stock market risk? I was sitting with a couple of weeks ago, a married couple, sitting down with them a few weeks ago, and they had a substantial amount of money sitting in CDs. Their CDs were paying 0.75%. That's it. 0.75% is all they were making. And they had a sizable amount of money invested in their CDs. And I showed them how our fixed indexed annuities have averaged a little over 5% per year over the last 13 years. Of course, past results are no guarantee of future returns. We have to say that. But our strategies using fixed indexed annuities never, ever put your principal or your annual gains at risk. The companies that we use are strong, solid insurance companies, and they link your returns to stock market indexes like the S&P 500 or the Dow or the Russell 2000 or other indexes. And over the course of a year, these companies track those indexes. And in the years when the market is up, you'll have a gain in your account. You'll share in those market gains, and that gain will lock into your account. So if you have $50,000 in there, as opposed to having it in a CD yielding next to nothing, and we see a nice 10% gain, say, in the S&P 500, you may capture a 4 or, say, 5% gain in your account. But once that gain is realized, once that, for example, 5% is gained in your account on that annual basis, it locks into your account, and it becomes your new principal. And you can't go below that unless you reach in there and take out the money. So if you're stuck with cash on the sidelines or stuck with cash in money market or low-yielding CDs, give us a call, and we'll talk. Our number is 791-5773. That's 791-5773. Now, remember, we do have our free educational workshop coming up this Thursday, 6 p.m., here in Baton Rouge. Thursday at 6 p.m., a free, no-obligation workshop, a chance to talk about some of these strategies we're talking about, showing you how to get that guaranteed retirement income out of your portfolio. Also, we'll talk about the government's debt, indebtedness, the real story of our American debt, and what it might mean for Medicare and Social Security. To register, simply call us, 791-5773. Just a few seats remaining for Thursday night's event at 6 p.m. Back with more of Your Money Matters in just a moment.